Be Wealthy and Smart, episode 1191.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to explore a dangerous question. Is the U.S. government preparing for a default? Now, as I said on my last podcast, we've been in this place before. Congress has come to an agreement over 70 times when we've gotten to the brink of not being able to agree. This just feels to me like a manufactured crisis. It feels like it's purposeful that both sides are digging in their heels and that they are going to cause a default. That's just how it feels to me. I could be wrong. Now, there's a recording I'd like you to listen to. This is what the media is preparing us for. And George Papadopoulos is interviewing Janet Yellen on ABC, and he is wanting her to paint a picture of what would happen if the U.S. did default on their debt. This is the kind of conversation that's going on in the media where they're trying to prepare us, they're trying to scare us, they're trying to get everybody to understand that this is about to happen. That's what it seems like to me. So let's listen to what George Papadopoulos and Janet Yellen say would happen in the event of no agreement on the debt ceiling and a debt default.
Paint a picture for everyone. What happens on that day? Let's assume for the sake of argument it's June 1st. What happens that day if the debt limit has not been extended?
Well, Treasury finds itself in a position where we're unable to pay all of the bills that come due that day. And this would be really the first time in the history of America that we would fail to make payments that are due. And, whether it's defaulting on interest payments that are due on the debt or payments due for Social Security recipients or to Medicare providers, we would simply not have enough cash to meet all of our obligations. And it's widely agreed that financial and economic chaos would ensue. U.S. Treasury securities are the safest bedrock security underlying the global financial system. A failure of the United States to honor all of its debt would call into question our credit worthiness. Even as we get very close to this date, if Congress doesn't act, we're likely to see financial market consequences. In 2011, there was a steep decline in the stock market and our borrowing costs. Back in 2011, the U.S. Was downgraded by the credit rating agencies. There would be permanently higher borrowing costs for Americans for buying a home, buying a car, and a failure to raise the debt ceiling would cause a steep economic downturn.
So there, the Treasury Secretary is painting a very bleak picture in case of a default. But what does it really involve, and what are the risks? Well, the last time this happened, the U.S. had its credit rating downgraded, and interest rates on existing debt shot up. And that could still happen even if the nation avoids an actual default. Janet Yellen also said if Congress fails to increase the debt limit, it would cause severe hardship to American families, harm our global leadership position, and raise questions about our ability to defend our national security interests. CNN said, to be clear, a debt default doesn't mean all payments would stop and people would permanently lose out on money that they owed. Treasury would have the funds to satisfy some obligations, but it's not certain how the agency would handle the disbursements. Much would also depend on how long it takes Congress to address the borrowing cap. Shai Akabas, Director of Economic Policy at the Bipartisan Policy Center, said tens of millions of people across the country who expect payments from the federal government may not get them on time. And there are 5 ways that Americans could be affected by debt default. Number 1, Social Security payments. About 66 million retirees, disabled workers, and others receive monthly Social Security benefits. The average payment for retired workers is $1,827 a month in 2023. Almost 2/3 of beneficiaries rely on Social Security for half of their income, and for 40% of recipients, the payments constitute at least 90% of their income, according to the National Committee to Preserve Social Security and Medicare. These payments could be delayed in a debt default scenario, though it's possible Treasury could continue making on-time payments because of the entitlement program's trust fund, Akabas said. Max Richtman from the Congressional Budget Office said even a short delay in the payment of Social Security benefits would be a burden for the millions of Americans who rely on their earned benefits to pay for out-of-pocket healthcare expenses, food, rent, and utilities. Many other government payments could also be affected, including funding for food stamps, federal grants to states and municipalities for Medicaid, highways, education, and other programs, and Medicare payments to hospitals, doctors, and health insurance plans. The second way Americans could be affected by a debt default is federal employees and veterans benefits. More than 2 million federal civilian workers and around 1.4 million active duty military members could see their paychecks delayed. Federal government contractors could also see a lag in payments, which would affect their ability to compensate their workers. Also, certain veterans benefits, including disability payments and pensions for some low-income veterans and their surviving families, could be affected. Rene Campos, Senior Director of Government Relations for the Military Officers Association of America, said such calamity would place further stress on our service members, retirees, and veterans, as well as their families, caregivers, and survivors. Though life in uniform is not always predictable, those who serve or have served their country expect their country to honor their commitment to service. About $25 billion in pay or benefits for active duty members of the military, civil service and military retirees, veterans, and recipients of supplemental security income is set out on the first day of the month, according to the CBO. The third way is financial markets. Americans' investments would take a direct hit. Markets had what was their worst week since the financial crisis during the 2011 debt ceiling standoff after the Standard & Poor's downgrade. Around $12 trillion in household wealth could be wiped out, according to Moody's Analytics. The fourth way is through borrowing costs. If a default occurs, yields on U.S. Treasuries will inevitably rise to compensate for the increased risk that bondholders won't receive the money they're owed from the government. Since interest rates on loans, credit cards, and mortgages are often based on Treasury yields, the cost of borrowing money and paying off debt would rise. That's on top of the increased costs Americans are already facing from the Federal Reserve rate hikes. Families and businesses would also have a tougher time getting approved for lines of credit, since banks would have to be more selective about whom they loan money to. That's because their costs of borrowing money will also rise, which limits the amount of money they can lend out. And the fifth way is it will impact the economy. A debt default could trigger an economic downturn, which would prompt a spike in unemployment. It would come at a particularly fragile time when the nation is already dealing with rising interest rates and stubbornly high inflation. How much damage would be done would depend on how long the crisis continues. If the default lasts for about a week, then close to 1 million jobs may be lost, including in the financial sector, which would be hard hit by the stock market declines. Also, the unemployment rate would jump to about 5%, and the economy would contract by nearly 0.5%, according to Moody's. But if the impasse dragged on for 6 weeks, then more than 7 million jobs would be lost. The unemployment rate would soar above 8%, and the economy would decline by more than 4%, according to Moody's. The effects would still be felt for a decade from now. It would be a body blow to the economy, and it would be a manufactured crisis, said Bernard Yaros, an economist at Moody's. See, he said it. It would be a manufactured crisis, and that's what this feels like to me. Both sides of politicians know that this is terrible for both of them. They know it's terrible for votes. They know it's horrible for future campaigns. And in the past, they've always been able to come together and agree. The timing seems very interesting to me right now, like something is planned and this is not coming together. I can't prove it, can't put my finger on it, but that's just how it feels to me, is exactly what he said. This is a manufactured crisis for some kind of a purpose. The crisis always comes before the solution that they have for us that they want to really present as the miraculous answer. We'll see what happens, and I'll continue to report back to you. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.